So welcome, 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 everyone. We are so excited to be here because every day is a beautiful day. And we're really thrilled and happy to have Charlie Sellari with us. He is an expert in his field of a CPA. And today he is going to talk about, well, I'll let Cliff do a nice introduction and let Charlie talk about what he's going to talk about. It's way more fun when the experts speak. So Cliff.
Charlie Sellari brings to us over 16 years of experience as a CPA and a tremendous amount of experience in working with real estate investors and high net worth individuals as it pertains to real estate and many other things. He is a firm principal with Blalock Martin Sellari LLC in West Palm Beach, Florida, one of the top firms in the state. They have a presence in many states across the country, and where they don't, they have connected affiliates where they can do referrals. We're very excited to have him on our show today. He's going to be talking about 1031 exchanges and cost segregation. And with that, I'd like to turn that over to Charlie. And there will be a brief presentation in the beginning. The remainder of the call will be Q&A. So Charlie, with that, it's yours.
Thank you, sir. Thank you, sir. So now you guys can stop me at any time you want. And I very much like questions, and I am more than happy to go over, whatever you want. I generally find a back and forth is usually a much better presentation than just watching me read slides and kind of ramble on about everything. So, because the idea really of this was, to kind of go over the basics, sort of just to get, your minds going, some of the basic rules, and then we could sort of go over, more interesting specifics and various ways to do this. Because I would, a lot of people have sort of heard of at least one of these or maybe both, but there's quite a few interesting things that you can do to really put a lot more power behind them, let's say. So I'm just going to start this slideshow, share my screen. All right. Now, if I did not screw this up, you guys can see my PowerPoint slides.
Yes.
We do.
All right. All right. Look at that. Like an old pro at this point doing this. All right. So we're just going to go over the basics of 1031 and cost segregation studies. The first one is 1031 exchanges. And this allows for the exchange of properties without recognizing capital gains if various requirements are met. I forget exactly when this rules came into play, but it was something like the 1930s. And like a lot of very tax favorable rules, it was meant for farmers, actually, because what they used to do back in the day was that farmers would swap land. So, you would have a cotton field, the other guy would have a corn field, or, your land would be good for this and his would be good for that. So people would just swap land and say, all right, well, I want a bunch of cows. You got great land for corn. So why don't you give me that 50 acres? I'll give you that 75 acres. And now we can let the land rest for this, and we can do this, and we'll just swap land. And they used to do it all the time. And so what happened was, before that, this law came, into effect, because the barter is actually a gain recognition. So like if I tell you, hey, why don't you come and wash my car for the next 6 months and I'll prepare your tax return for you, we're actually both supposed to pick up income. I got $1,000, the car wash is free, you got $1,000 tax return free. We're actually both supposed to go pick up $1,000, even though we didn't pay anybody anything. And so without this rule, what was supposed to happen was that these farmers were supposed to pick up all of this gain every time that they swapped land around, and said, gee, that's not great. These farmers, don't have that much money. We really need these guys. And so they said, fine, you guys can swap land for land, and we won't make you pick up any gain as long as nobody gets any money. And that was the start of 1031 exchanges. And then it's gone. Like most things, starts off simple and it builds and builds and builds and builds and builds. It gets much more complicated over the years. And now a big one is that the gain is simply deferred. So you're not getting rid of a gain. So, you know, if you sell a property you paid $100,000 for, you sell it for $1 million, go buy another, you know, $1 million property. You didn't get rid of that $900,000 gain. It doesn't vanish. It's just simply really built into the new property. So when you sell the new property, you would have to pick up the gain at that point in time. Both properties must be used in trade or business or held for investment. So for instance, people say, I want a 1031 my house. You can't do that. It's got to be like a rental property, property used in a trade or business. So, you know, we don't own it, but if, you know, we owned our building that we run our firm out of, that would be a property that would qualify. So it's got to be used in a trade or business. Now, under the Tax Cut and Jobs Act, which is also known as basically the Trump tax cuts, only real property can qualify for 1031 treatment. It used to be a whole bunch of property, like cars. Like if you traded in a car, that was a very common one. It used to be a 1031 exchange. So now it's basically building and land. That's really the only thing. There's some intangibles that qualify if really the underlying stuff is building and land. There's a few things you could technically get. Actually, one of the big reasons they changed it was on this next one. People were actually using 1031s for Bitcoin and other cryptocurrency transaction, because Bitcoin is not a security technically. So you could not 1031 exchange security. So you couldn't 1031 exchange Apple stock. You weren't allowed to do that. But Bitcoin wasn't a security. It doesn't go in brokerage, isn't regulated like that, isn't defined as a security. So actually people were using 1031 exchanges in order to diversify their Bitcoin. They were selling Bitcoin, buying, you know, dodgy coin, all that kind of stuff, and trying to diversify because they had just ginormous gains in there. So anyway, now it's only buildings and land, things you can, you know, touch. I know somebody had a question. So one of the things you have to use with a 1031 is you got to use what's called a qualified intermediary. And this is a person or company that will hold your money until you either complete the 1031 exchange or there's no possible way for you to successfully complete the exchange anymore. And so what I mean by that is you can't sell your building, go put it into your bank account, and then go buy the replacement property a couple months later. You're not allowed to do that. And the reason for that is the story I told you at the beginning for the farmers, because this was really defined for, I will give you my 50 acres, you give me your 50 acres, and we're literally swapping land, and there was never any cash involved. Eventually, they let go the deferred exchange, which is what everybody thinks of now, which is, you know, you sell your Dollar General, put it in with a third party, they hold your money, and then, you know, you pass a couple of other rules. That third party buys the building, the new, you know, the Walgreens, the CVS, or whatever on earth that you buy, and then they give you the CVS or the Walgreens. And it seems silly, and the reason they do that is to go back to that farmer store, because you're never actually supposed to have gotten the cash. If you ever touch, the minute you touch the cash, you have been deemed to get it, and then you have to recognize the whole gain, and you can't do a 1031 exchange. So that's, anyway, that is why you're required to go through those people. And they've gotten a lot better, but really the main trick to go through those, remember, you are giving some private company a lot of your money. And so one, you want to make sure you actually get the 1031 done, but two, and more importantly, and this happened a lot in 08, 09, you know, 10, they just took people's money and ran. So they have gotten much better over the years, and they have started to generally put in safeguards to protect the owner. So not that the owner can get the money, but that the owner of the 1031 exchange company can't run with it without your signing off on something. So anyway, that's what those guys do, and that's why they're in this process. Now, so once you sell your property, you put a bunch of money in with a qualified intermediary. There's the two other basic rules. You got the 45-day rule, which is known as the identification rule. And the standard rules, you can identify up to 3 properties regardless, of value. So you sell something for $2 million, usually people will try to identify a couple of items worth at least, 2 million or more, or they'll identify 2 items worth 2 million each. And then you sort of try to figure it out. Because once you've gotten that 45-day rule, day 46 comes by and you find the perfect property and it's for $2.1 million, it doesn't matter. If you didn't, identify it within the first 45 days, you cannot use it for your 1031 exchange, period. Now, there's 2 other rules you can qualify. The 200% rule, you can identify as many properties as you want, as long as their value does not exceed 200%. So this is usually when somebody sells one really big thing and they want to go buy a bunch of like rental properties, or you sell one big thing for $50 million and you don't want to have one big risk anymore. You want, gee, I would like to have, I'm going to go buy 20 Dollar Generals and 5 CVSs and yada yada. I'm going to go reinvest my 50 million, but I want to spread it over a whole bunch of assets. That is usually when that rule comes in. Somebody's looking to diversify. And so anyway, you could do 20 assets as long as it's not more than 200% of what you sold. And then there's the 95% rule. And so anyway, you just have to make one of these 3 rules. And it's, you can identify any number of properties as long as you close on at least 95% of the aggregate value of them. That is probably the rarest one, because that is basically, yes, you can identify 50 things, but you basically have to close on like 49 of them, 48 of them. There's in which case it's possible. I've never seen it, but it's possible. And then step 3 is you have to have the closing within 180 days. And that's when you actually have to have the closing done, which is anybody involved in this stuff knows it sounds like a lot, but 180 days. Oh, I'm sorry. I just downloaded the chat. Hey, Mark, I'll get back to you in just 1 second. That goes really fast. 180 days in real estate, especially when you're talking about a multi-million-dollar asset, is very, very fast, especially when you have to identify things in 45 days. So anytime I get, like involved in this, I tell people, start searching the moment you sign a contract to sell your property. Because the moment you sign a contract to sell your property, they have a due diligence time. They got to go get, loans. They have to go do all of this stuff. And so they're going to spend months, in which case what you should do is that you should spend as much time as possible looking for replacement property. Because when people start trying to buy multi-million-dollar properties, or hell, $500,000, $1 million properties, and you're rushing to do it, that is when people make very bad decisions. Because taxes only matter if you make money. If you lose money, it's not a big deal. Taxes aren't really that big of a deal. You've just lost a bunch of your money. So taxes are only a problem if you make money. So 1031s only really work if the property you buy is a successful investment. Yes, you may have not had to pay a $200,000 gain, but gosh, if you lost $1 million because you bought a Dollar General and 6 months later the Dollar General doesn't renew and it's in a weird part of town and you can't reuse that building because it's made funky or something like that, well, shoot, that was a terrible deal. So anyway, timing is a very big deal. And just by the way, you can buy the replacement property first, which is a reverse like-kind exchange. The problem with that is cash. So if you're selling a property for $1 million, what you do is you give $1 million to the qualified intermediary. He buys your replacement property. He will hold it, for up to 6 months. And then when you sell your property, he'll then hand you the property you bought 6 months ago, which every once in a while comes in. Usually the only time it comes in is if somebody has found the property that they really want. It was a fantastic property and they happen to have the cash, but then it's a little bit hard to sell their property and the time's not, like it's not lining up right. And so they really want to lock in the property that they're trying to buy. So they're going to lock it up. They're going to own it anyway. and they're just kind of hoping they can sell their property within 180 days. That is the most common way. Now, Mark asked, when the gain is deferred, what is the basis upon sale? It gets complicated, but I'll give you a basic answer. So if you had a property, you paid $100,000 for it. Let's just say there was no depreciation, at all. Your basis would be $100,000. If you sell that property for $1 million, okay, and then let's just say everything works out absolutely perfect and you buy a replacement property for $1 million. Your basis in the new property is $100,000. And that's what I was saying. Your gain is just deferred. You don't actually, because you just take the basis into the new property, so that when you sold that new property for $1 million, and let's say you cashed out, you would have the whole $900,000 gain. Now, let's say, for instance, you sold that property and you go get a bank loan and you get a $500,000 loan and you buy property for $1.5 million. In that instance, the new property would have a basis of $600,000. The $100,000 that was carried over from the old property, plus the $500,000 you put into the new property. So you would get all of the new money that you put in, but the basis carries over from the old, money, if that makes sense.
Got it. Thanks, Charlie.
So Charlie,
Yes.
when somebody comes to you, when a client, let's say me, and I've just sold my property or done a 1031 exchange, what information do you need from us? And how does that benefit us as a taxpayer?
Well, the main one is that you don't have to pay Uncle Sam. That's, we'll go back to my $1 million, example. You would just have to have the depreciation schedule on the old property, because I know what your basis is. So the $100,000, you'd have a depreciation schedule that said, my base was $100,000. And then you'd have a HUD on the new property that said I bought it for $8 million, and you'd have the HUD on the sale. Because really, you're just trying to figure out whether you qualified and what your basis is on the new property. And of course, the trick is to make sure that you completed the 1031 correctly. Because it is a bright line test. There is no intent. There is no, gosh, you were trying to be a good boy, but you missed step 3C. Don't worry, we'll give it to you. This is definitely it is a checkbox type law. You either checked every one of these boxes or you did not. And that is it. It is that simple. There's no any other, factors, that go in. You either completed it perfectly or you pick up the game.
So then does that mean that I should give you a call and say, look, I'm in the middle of a 1031, or should I call you and say, I'm going to do a 1031, or when should I call?
The best route is I'm thinking of selling a property. That is the best time. I'm going to sell this Dollar General for $1 million. I'm going to sell my building, my practices. I'm retiring. I'm going to sell this building. I want to, I'm thinking of selling, because that's the best time to figure it out. Because it's a question of, should I go through a 1031 exchange? Is it even worth the hassle? Because sometimes the answer is, gosh, look, you're only going to pay $4,000 in taxes. Hey, you're going to spend $1,000 trying to figure this out. And now you got a 45-day rule. You got less time to figure this out. Just pay the $5,000 and move on. It's not worth the hassle. I've told people that before, don't do it. Just
Don't do
that
what?
way you can spend 3 years to find replacement property. You don't have any of these problems. So that's step one, is just, is it worth it? And then, but anyway, that's the best time, is before you sell. So that way, everything you need to do, what makes sense, how much money you have to reinvest, if you have to add in more money, because it is pretty rare you sell a property for $1 million and you're going to buy property for exactly $1 million.
No chance.
That never happens. It's always something like this. And then you get into questions of, well, gee, what does that mean? Does this make sense? Do I have to come up with more properties? Are they like kind? All that kind of fun stuff.
So would you tell me, so because it's a good time before, and I tell you, okay, I'm thinking about selling, I don't know if I can. will you tell me what my tax position is? For instance, would it be better if I did a carryback? Or what would my tax position be if I did a carryback? What would be my tax position if I decided not to do a 1031? And then what do I really need to do to have a successful 1031? And then what about going into a DST? Would it be better to do that? For instance,
Well,
do
DSTs
you
use
advise
1031
on that or?
Yes, yes,
Yes,
yeah,
you do.
because that is all of the conversation, because really it's a question of, should I do this? Doesn't make sense. How much am I saving by jumping, like through these hassles? Because there's extra costs, extra hassle, extra stress. And for most people, this is a big portion of their net worth. And if you try to rush and do things poorly, it's a terrible idea. So it's very much as much information as you can have, and as much heads up you can have, and as much time you can artificially add to these rules, hopefully the better result you'll have. Now, like you mentioned, a DST, which is a Delaware statutory trust.
That's one of them.
That is one of them. That is really actually just it's an easy replacement asset is what that is. That is, they use 1031 exchanges, and their main sales pitch is, if you don't want to screw around with property anymore, you just want to be a passive investor, you can use one of these DSTs and go into one. And they have spent a lot of time, because it's just the nice thing is all you have to do is write a check. You identify which kind of asset they want, and then you say, okay, I want to buy that. You write a check, you're done. That was the end of your work that you have to do. But there are more fees and stuff involved in those, but that doesn't make it bad. It's just a fact of life, which would make sense. If I have to do all of the work, I would expect to pay less fees. If the only thing I have to do is cash a check, well, I'm assuming I'm paying somebody to do the work. And a DST has that basic factor. But yeah, so we would get involved in all of that stuff, because that is very much one of the options. And that's one of the things that you can identify. And some of that matters on whether you're a 30-year-old, a 30-year-old, I'm going to go, be the next, Elon Musk and become a billionaire, versus, gosh, I'm 70. I don't have the energy to deal with this crap anymore. I don't want to call and fix roofs. I don't want to do this. I'm getting old. I'm worried about my health. And then you can get into things like, gee, I've heard about a step up in basis upon death, and I don't want to pay tax. I want to just leave this to my kids, get a step up in basis, and then they can sell this without gains. And so you can get into all kinds of fun stuff and say, okay, we'll go do a 1031 and then do a refinance. And anyway, I'll get into that kind of stuff in a minute. But yes, there's all that. Really, that is all part of the conversation of, should I do a 1031?
Right. And there's a deferred sales trust, which is different than the Delaware.
I'm not familiar with that particular one.
Okay. Right. Cliff's got a question. Can we just have the group and we'll come back to your sharing later while we're in?
So, yeah, my question is, on a 1031 exchange, if I have $1 million property and I wanted to invest in another property, can I invest in a property that's less than that $1 million, or does that entire $1 million need to go into it, or a specific percentage amount?
I have a slide on that. I wonder if that's my next slide.
Okay.
That might be. That is the next slide.
Okay.
Cover this right here.
Great segue.
Good segue. Well done. Well done, Cliff. So, how expensive must the replacement property be? To get full deferral, you have to use 100% of the cash. You also need to replace 100% of the debt. This is one that people get messed up a lot. So if you have a property worth $1.5 million and you have $1 million mortgage on the property, so you are only going to get $500,000 of cash at closing, you cannot simply take the $500,000 and go buy a new property. That would be $1 million of boot, and you would pick up gain associated with that. So not only do you have to use all of the cash, but you have to replace all of the debt, which can be a major issue. Food is any money you receive from the sale will result in gain recognition. Note, it is assumed all of the money is made up from the gain layer of the sale. So the way you do the math, the basic way you do the math is the worst possible way you could do the math for the taxpayer. So we'll go back to my, we have, gosh, $1 million property, basis of $600,000. Gosh, let's just say you buy Dollar General. I have a lot of clients who have Dollar Generals if you couldn't figure it out. And I bought one for $500,000. Okay, so I reinvested half of the money. If you did that, you would get exactly 0 gain deferral, and you would pick up all $400,000 gain, which was the $1 million minus $600,000 of basis. Because the way that the math is done, you reinvest the basis first. The gain gets reinvested last, which, as I said, is literally the worst way you could possibly do the math for the taxpayer. That's how the IRS says you are required to do the math. So that becomes a major issue when people are like, oh, well, I'm going to sell something for $5 million. It's okay. I'm going to reinvest $3.5 million. Well, Joey, you only have $1.7 million gain. You're only going to defer $100,000 gain or $200,000 gain. You really need to go replace more. Now, for somebody who had $1 million sale and $100,000 basis, well, now going and buying $500,000 property isn't that bad. Now you avoided $400,000, of gain. That's not so bad. That may, that very well may be worth it. So anyway, that is a problem, but that is how you do the math. So typically for people who want to cash out, the typical way of doing it, because you can't cash out at the time you close, but you can refinance afterwards, or you can put a second on it. You cannot have it contractual in nature. You can't put a line of credit, for instance, and say, okay, I'm going to buy this and I'm going to get a mortgage for $1 million, but I'm going to have a line of credit on it for $600,000. And then I'm going to close. The fact that you had the ability to pull the money out, a legal right to pull the money out, means they'll assume you have pulled the money out. So what you do is you buy the property with $1 million gain, or I'm sorry, with the $1 million mortgage on it. That way you satisfied everything. And then 6 months later, you go to the bank and say, hey, I want to put a second on this, or I want to refinance this. I want to do that, yada, yada, yada. And I would like to, to pull out the $600,000, the $1 million. Yes, Mark, go ahead.
So you can exchange, looks like one property into several properties. That's not a problem. Can you exchange several properties into one property?
Theoretically, yes. You would have, it would be similar to like a DST. You would do a tick. And then what you would do is you would do a 1031 into a tick interest. And then once you have done several of them, your problem is your timing would be, theoretically you could do it. It would be the practical side of trying to sell all of these different properties and buying one property. Now, if you had, it would not be bad at all if you had one guy buying 5 properties. That would be very simple. Now you could do it, no problem. But if you were trying to sell, 5 different properties over the course of 2 years and try to take all that money and invest into one big thing, there'd be no real way to do it. So that would be it would be your 45 and your 180 day issue. That would be your hurdle. Technically you can do it, but that would be your fight.
Yeah, it would take a lot of planning
Looks great.
to have that be successful.
If you ever wanted to do something where you wanted to do.
Yeah, no, you would pretty much have to have one buyer or 1 or 2 buyers and get them to coordinate. If you only had 1 or 2 buyers that you had to deal with, you can usually make it work. But if you're trying to coordinate 4 or 5 buyers, good luck to you, sir. It's possible, but you're gonna lose all hair you may have left. Pulling those things out, trying to make that.
You must not be able to see my picture because that's too late for me.
Any other question, Mark? Because Cliff's got a question too.
No, thank you. Go ahead, Cliff.
I have a question after Cliff, so.
Okay, Tim.
Okay. So my question is, if I heard you correctly earlier, there was a way to actually do a 1031 exchange, and then at the time of death, you could do an appraisal and do a step up. And then there was something you said after that. So what's the path or methodology about avoiding legally as much taxes as possible from that point?
Die.
Oh, okay. It's the real estate barons have been doing it for years. Because basically what the idea is, dad or grandpa bought these properties when they were worth $10 and sells them, buys more property, sells them, buys more property, keeps doing 1031 exchanges. He puts more and more money in. But usually the way that dad makes his money is he goes and gets bank loans, pulls money out of these things. That's where he gets his cash flow from. And what happens is when dad dies, grandpa dies, he never paid any gains. He was using 1031s his whole life. When you die, you get a step up in basis on the properties. So dad may have had literally $5 in basis, but these things were worth $20 million. So the moment he dies, the basis becomes $20 million. And then it'll go to a trust, it'll go to the kids, it'll go to whoever it goes to. Well, those kids inherit the property with a $20 million basis. So what they can do is they can sell the properties. Their basis is $20 million. Fair market value is $20 million. They pay zero tax on the sale. They take the money and go away. So a lot of time, which is partially where a DST comes in, that's a major sales pitch for a DST, is grandpa's too tired to manage the properties. Kids not step in. Well, I don't want to pay a tax. I'll park it at a DST until I die. Get the step up basis, cash out. And there are sometimes, like they'll just hold the property or the family property or whatever they do. And so a lot of times it's partially why grandpa will not ever sell these properties. Because he will pay out the wazoo. Sometimes he'll pay more than he'll get for closing. Because especially if grandpa has been refinancing it for years, it may be worth $20 million. He may have a $10 million debt on it. But if his basis is $10, especially if he's in a place with a higher state tax, he may owe $10 million in taxes, like upon sale. And so I have seen people, pay more tax than they actually got at closing because of that kind of stuff. And so anyway, sometimes they'll do that. So it's not uncommon to have the kids sell, and that's part of the family plan.
Right. Could you stop sharing your screen, Charlie? Then Tim has a question.
Sure.
There we go. Thank you.
Just
All
by
right,
the way,
so-
I did have a part on cost seg studies that anyway, I didn't know how much time we had.
So my question was,
Okay.
how do the calculate the value of the new property? Do they go by the purchasing price or by the appraised value of the property? So
Actual cash paid.
cash paid. So in other
Yes.
words, if
Cash
you
and
had,
debt.
okay, so if you had, say you found a distressed buyer that had $1.5 million property that was selling it for just $1 million, and you had a property that was worth $1 million that you could sell 1031 it for the property worth 1.5, but you're only paying $1 million for it, that would be worth doing, kind of thing.
Correct. And the number that matters for this purpose is $1 million. Everything in the tax world is generally done on what is actually paid. There's some estate tax where the appraisal matters, but all of this stuff, it's actually what you paid or the debt assumed.
Or tax.
So actually, that's that clear.
Yeah, but that advantage of that, Tim, is in 6 months or so, you go to the bank and get that $500 and put it in your pocket or go to make another investment.
Exactly. Exactly.
Yep.
Any other 1031 questions or CPA questions about 1031? Okay, so
I have a question.
yes, please.
I just want to be clear on the fact that if you took those capital gains and invested in an opportunity zone, then you really owe no taxes at the end of 10 years.
Correct, but it's only the capital gains. So if you sold a property for $1 million and your capital gain is $200,000, you only invest $200,000 in the opportunity zone. And then you do get the 10% haircut on, because you don't actually, you still got to pay tax on the $200,000 that you invest, but you get a haircut and a deferral. I think it's 10% now, it's the biggest. And what goes away forever is if you buy the new property, and that new property you pay $200,000 for, it goes to $1 million, and you held that for at least 10 years. That is the gain that goes away entirely, not the $200,000 gain you put into it.
So if you're selling a property you own and you had a $200,000 gain, you're just selling the property straight out and putting the 200,000. Are you doing through a mediator for that
No,
gain to
no,
go
because
into the
for an opportunity zone, you actually need to recognize the gain. The whole idea of a 1031 is to not recognize the gain,
Okay.
not pick up the gain. For an opportunity zone, you have to pick up the gain.
But you don't pay the taxes on that gain until a few years down the line.
I think it's April 2025. I think is when you actually pay the tax, and you get a 10%. It was 15%, and
Yeah, it
that
was.
ended.
Yeah, they keep
in
knocking it
19.
down.
I think it's 10% now.
Right.
And in an opportunity zone, you also don't have to replace the debt if you're using your 1031 capital, because that's what I may be doing soon.
That's a whole separate. Yeah.
Yeah,
1031 is a don't pick up gains. Opportunity zone is generally purposely create gains, only put the gain into the opportunity zone. And
Right.
then you get a deferral on the gain, and it's the underlying investment that after 10 years you can avoid. Now, the other part to that is you also have to improve the opportunity zone.
Sure.
So if you put in 200 grand, you gotta buy something and then improve it for as much as you paid for it.
Right, but if you're putting it in passively and you're not the one running it, you're just putting it into an opportunity zone.
Yeah.
You better hope the person who's running it does it right.
Yep.
Because
Yeah,
if the,
of course. Yeah.
they're having to do it.
So-
So if they screw up, it's your problem.
Yeah, we got that. So if there's was a loan on the property and they're putting they don't have to consider the loan as a loan that went away as boot?
No, you would, because what you're doing there is you're purposely not doing a 1031. You aren't trying to do a 1031 at that point. You are recognizing the gain. And
So
you're just
do I have
taking
to
the gain.
recapture my depreciation? Do I have to recapture any of the depreciation?
Yep, because this is just sell it for cash, put the cash in your bank account. You're just taking the
oh,
gain.
okay, I get it. So right now my funds are with the 1031 custodian. So I guess if I end up investing it in an OZ, then the 1031 custodian will no longer have a reason. I mean, I don't need him. I have to pay him, of course, but I don't need him further.
Usually the fastest way to get out of the custodian is to fail the 45-day test. Because if you give it to a 1031
Oh, yeah.
guy, 10 minutes later say, give me my money back, they'll tell you no. They'll tell you I'm not allowed to. And
He already
so-
has my money. No, he already has my money, and he does know that there is an OZ thing that one can do. Yeah.
Yeah, but that's, anyway, usually they won't give you your money back for at least 45 days. That's
5
usually
days,
the
yeah.
fastest you can do it.
Right.
Okay. Thank you.
Welcome.
Any
So I have
other?
I do. I have a couple of questions and one rolls into the next one. So on a 1031 exchange, if I'm able to do a double closing and time it where the money remains in escrow and I never receive possession of it, can I bypass the use of a qualified intermediary? Or if not, then why? And then my second part of my question is on QI, what's the best way to find a good qualified intermediary? Because they're taking possession of your money, so you need to be able to vet them properly.
True. For the first part of it, you have to, I mean, you could use a lawyer, like, like you don't have to use a 1031 company. A qualified intermediary is a fact and circumstances test. It's not a license. It's not anything else. You could literally send the money to my firm and we could draw up a little contract that says, I won't give Cliff his money no matter what. And I'm going to do 1031 stuff with it. And you send it to me and we hold the money, we put it in our firm escrow account, and then, we go and buy the property and give it to you. And I'm not a qualified, like I would not tell you to do that. But anyway, I could just turn into one tomorrow. And so the rule is really, as long as it's a third party person and you don't have the right to demand the money, which is why they won't give it to you for at least 45 days, because they don't want to have somebody put in the argument that it's really Charlie's holding Cliff's money, and therefore really Cliff can demand it at any time and Charlie will hand it over. Therefore, Cliff really had it the whole time, and he's got to pick it up. And so that's why they play that whole game. And so anyway, technically, yes, you could put it into escrow with a lawyer, but that's the argument you're hoping the IRS doesn't make, is that to say that, oh, he's your friend, he would have given it to you, had a legal right to it, therefore it didn't qualify. As far as a qualified intermediary, I have one that I've worked with for quite a few years now. I don't know him particularly well. I have had several clients go to him. I kind of vetted him at the beginning, and I thought their firm did a good job. So I've been using him for years. Most of it is just make sure they can't take your money. A lot of them will set up a bank account. There will be a separate Cliff Morgan bank account or a Charlie Sellari bank account, and it'll be a dual signer account, or it will be things like that, to where I'm just going to assume this guy's a jerk. Let's just assume he's got a problem. He's trying to steal from my money, but I want to make sure he is not legally allowed at all to get this money without me signing something. And I tell people, just assume they're a bad guy and read the paperwork that way. Because if he can't possibly do it, he won't do it. Otherwise, you're having to deal with trust, and that is a lot of money to trust somebody with. In which case, I would rather just go into it assuming they're a bad guy, hoping I'm wrong, but just having the paperwork done that way.
Good advice. Yeah, we know people that have run off to Mexico or some other country with millions of people's money. And
they were really nice up until they weren't.
And we know some really good people. We've been working with them for years and years and years. Okay. Unfortunately, the rules are set up not to protect the individual's money. It should never be allowed to be given to another person. It should absolutely be held in an escrow account, not in the name of the exchanger. Frankly, that's my own opinion about that. And you don't have to use you don't have to use one of those people. You could hire your own trustee to handle it. It doesn't have to be through a company specifically. You just need to have a third party handle your money and do the right thing.
Yep. It just has to be a third party.
Yeah.
Of course, the question is, they're all third parties, and so it's just a matter of finding one you trust and finding one that hopefully has enough safeguards in place that they can't be bad.
Yeah, we have some good people out here in California.
Good.
Yep. Been in the business a long time.
I know that you want to talk about cost segregation also, and we have actually spoken about cost segregation on previous events. I have a question though, kind of around the 1031 exchange and cost segregation. So some people, they have money that they want a 1031 exchange into another property to actually defer taxes and not pay them right now. But when would it make sense to actually look at the benefits of a cost segregation that's being performed on maybe a passive investment opportunity where it could potentially outweigh what they would be able to defer in a 1031 exchange?
I've never had anybody purposely avoid a 1031 just to get additional cost seg study. But I do have people fairly regularly combine them. So especially if you're selling a property for $1 million, you go out and get a bigger mortgage and your replacement property is a $2 million property. Well, great, you got $1 million of new basis and you can go do a cost seg study on that new portion. Because they can be used in tandem. And so usually when people are buying bigger properties, because a lot of times, like the young guy will go buy, I think it was Tim was saying about, I got a property buying for $1 million worth $1.5 million. Well, they'll go sell it for $1 million, like $1.5, borrow some more money, buy a $3 million property. And he's planning on doing that to get his portfolio larger and larger. Well, every time he goes buys another $1 million worth of property, he could do a 1031 every time. And I've definitely seen people do that because now like the other, like advantage is to do a cost seg when you buy the first property, lower the basis to almost peanuts, and then 1031 it into new properties. So the fact that you just took up all of your basis really, really, really fast doesn't really harm you. So you can definitely make those work in, together.
Yeah, so we're looking at a deal right now that if you put $100,000 into that particular, it's a multifamily in this case, they said if you put 100,000 in, you would get a 96% offset with the cost seg. 65% depreciation and 96% is offset. So is that something that someone should come to you first about?
Yeah, I'd have to see where they get their numbers. That's quite high.
I'm
I'm not sure what they mean by an offset. 65% depreciation makes sense, which would still be a little bit high. But anyway, the person buying it would do the cost seg.
I think it has something to do with the new rules that you can write it off in year one.
There's 100% bonus depreciation. So basically the nice things about cost seg right now is 100% bonus depreciation. Because what you're doing, I'll just give you the very, very basics of the cost seg. You take a building and what a cost seg does is breaks it into its components. So you take everything, as opposed to being 27.5 and 39-year property, you break it into 5, 7, and 15, and then 27.5 or 39-year property. Well, 100% bonus depreciation, everything in the 5, 7, and the 15-year bucket, you get to write off in the year that you bought it. So if you put 40% of the building in that bucket, you write off all of that in the first year. So you took it from being spread over 39 years, and now it's boom, all in year one. So that's the basics of what a cost seg is doing. So you can do it in the year you buy it. You could do it in the year, like the one I was talking about, before, where grandpa dies, the basis goes up to $20 million. The kid who gets it, he could do a cost seg on it. And now he's getting tons of depreciation. Or you could have bought one 3 years ago and said, dang it, I really should have done a cost seg. You could do one in year 3 and take all that catch up now. So those are the 3 basic times. You don't actually have to do the cost seg in the year that you purchased it. Now, granted, I wouldn't try to do one 20 years later. That probably doesn't make sense. But I've seen people doing 3, 4, 5, 6 years in and said, gosh, I should have done one. Okay, we'll go do one now. And you just take the depreciation now. So those are all times that it makes sense.
Thank you. Does anybody else have any other questions or comments? Because we are at close to the top of the hour. So you thought that you were going to cover 2 subjects, Charlie, but there's the fun part's the Q&A. And
I agree.
most people have questions. And I would say, well, I don't know how many of your clients have done 1031s, but I would say a minority of real estate investors do a 1031. There's just not that many that do. I find that real estate agents don't have a clue about 1031, do not advise their clients properly, and because of that, they end up not doing a 1031 correctly when they do attempt one, which is really too bad. You know, we're all about simultaneous closing, so you're almost looking at a reverse exchange as often as possible.
Which makes sense. I tell people all the time, it is one of the most tax advantage class. You know, people always talk about, oh, the oil barons get all these, you know, things. Real estate is every bit up there, if not more so, in my opinion, as far as what games you can play tax wise. It is just, if you know the tricks to talk to somebody, you can do a lot with it.
Yeah, and Gary's asking you, and I'm sure there's several people that would be very interested in having a conversation with you. So if you would post your email or however you want people to get a hold of you in the chat.
Charlie, if you'd
to do
like,
that.
so you can answer questions, I can type it in and put it in the chat for you if you'd prefer.
I think I have access. We'll see. Oh, I was trying to.
And hi, Charlie. I may not be doing something right on LinkedIn, but it looks like you're locked to send a message unless I'm premium.
Oh,
Still
am
not-
I?
Yeah.
I'm not a big
Neither
LinkedIn guy.
am I.
honestly.
Why I don't know the answer to my own question.
I think I set one up one time because somebody told me I had to, and I did it. And that was probably, you know, I think I've updated a couple times, you know, like when I became principal. And other than that, I probably go on it once a year.
And I'm pending too,
Oh.
Charlie. I sent it a while ago. I just noticed.
No offense.
This is April O'Connor. I actually meet him in person.
Oh, good. That's great. Hi, April. Thanks for coming.
Thanks for having me. This was great. Charlie, thank you so much. And
Welcome.
this is going to be posted on YouTube, Cliff said, for future.
Yeah, we're
Yes.
going to have it on our YouTube channel under the Nest Egg Builder. And this has been a phenomenal, opportunity to talk about 1031 exchange and have an expert like Charlie come in and answer questions that I know that I've had and I haven't really been able to get good answers for. And I'm sure a few other people had as well. So I really hope that this has been very helpful and beneficial. And I wanted to just open it up and make sure everybody had an opportunity to ask questions. We've got about 3.5 minutes left. So if you do have any questions, please raise your hand or speak up now. We want to make sure that you get your questions answered.
I do have a quick question, Cliff. You've mentioned a lot. We have a lot of realtors in our network, in our group. So Charlie, do you do a class? Do you do something specific, or is it just as requested, or is there anything
Just
regular?
as requested.
Okay.
I do some presentations, you know, like this and whatnot, but other than that, it's just, and like, I don't mind, you know, like people calling me because I'll have realtors sometimes, you know, like just call me to ask questions and, you know, I've got a client who wants to do this and things like that. And I try to help people out. I'm a certain amount of, go try to do good things for people and some of it will come back my way kind of person. So,
Yeah.
so
I'll share this
offer.
video and let them know that they can contact you for questions. But
Great.
Perfect.
I definitely need it.
Just by the way, I do need to go in a couple minutes. I have to drive my son to basketball. He's got to be there at 7.
Okay,
I've got about
Oh.
5 minutes, but then I got a hard stop. Otherwise, I'm going to get in
Oh.
trouble at home.
1 second. So thank you, everyone. And thank you, Charlie, very much
You're
for
welcome.
being here. We really appreciate it.